A very good day to everyone. I am Ms.Veena Priyadharshini, Assistant Professor, PG Department of Commerce, Shri Krishna Swami College for Women. Today, we are going to learn about an important topic in income tax law and practice, Introduction to Income Tax. This topic will help us understand what tax is, why it is levied, its types, and key concepts used in Income Tax Act. Let's begin by understanding what a tax means. Taxes are compulsory payments collected by the government from individuals and organizations. The main purpose is to meet the common welfare expenditure of society like building roads, hospitals, schools, and ensuring public safety. In simple words, tax is a contribution we make to the government for the benefit of all. Now, why does the government levy taxes? The reason is simple. Taxes are the basic source of revenue for the government. This revenue is used for national defense, education, healthcare, and development projects like roads and dams. Classification of tax. Taxes in India are mainly classified into two categories, direct taxes and indirect taxes. Let's see what each means. A direct tax is one that is paid directly to the government by the person on whom it is imposed. Examples include income tax and corporate tax. The burden of the tax and the payment both fall on the same person. On the other hand, an indirect tax is collected by an intermediary such as a retailer who passes it on to the government. The final burden of the tax falls on the customer. Example includes GST and custom duty. Now let's see the history of income tax. In India, income tax was introduced for the first time in 1860 by Sir James Wilson to meet the losses sustained by the government on account of military mutiny of 1857. In 1886, a separate income tax was passed. This act remained in force up to 1917 to 1918. A new Income Tax Act was passed in 1922. To prevent the evasion of tax, the Government of India had appointed the Direct Tax Administrative Enquiry Committee. This committee submitted its report in 1959. Finally, the Income Tax Act 1961 was passed. Income tax. Income tax is one of the major direct taxes in India. It was introduced through the Income Tax Act 1961, which came into force on 1st April 1962. It applies to individuals, into undivided families, firms, and other association of persons. The features of income tax. The main features of income tax are: it is levied as per the Constitution, imposed by the central government, and is a direct annual tax on the income of a person. It applies throughout India and is charged at prescribed rates. Income earned in one financial year is assessed and taxed in the following assessment year. To understand income tax better, we must be familiar with some key definitions under Section 2 and 3 of the Act. These include assessee, previous year, assessment, person, income, gross total income, and total income. Assessee. An assessee means a person by whom any tax or any other sum of money is payable under the Act. It also includes every person in respect of whom any proceeding has been taken under the Act. Previous year. The previous year is the financial year immediately preceding the assessment year. The year in which income is earned is previous year. For example, if the assessment year is 2025 to 26, then the previous year will be 2024 to 25. So, income earned during the 1st April 2024 to 31st March 2025 will be taxed in the assessment year 2025 to 26. Assessment year. The assessment year means the period of 12 months starting from 1st April every year. During this period, income earned in the previous year is assessed and taxed by the Income Tax Department. Assessment. Assessment is the process of examining the return of income filed by the assessee. The income tax department verifies the correctness of the return and determine the tax liability. Person. The term person under the Income Tax Act includes individuals, into undivided families, companies, firms, association of persons or body of individuals, local authorities, and artificial judicial persons. Income. Income as defined under Section 2, subsection 24 includes a wide range of receipts, profits, dividend, allowances, capital gains, perquisites, lottery winnings, any monetary gain, regular occasional may be treated as income for taxation purpose. Gross total income. As per Section 14, income is grouped under 5 heads: salaries, income from house property, profits and gains of business or profession, capital gains, and income from other sources. The total of these 5 heads is called gross total income. Total income. Finally, total income means the gross total income minus deduction allowed under the Income Tax Act. This is the actual amount in which tax is calculated and payable by the assessee. To summarize, we understood the meaning, purpose, and types of taxes, the basics of income tax, and key terms used under the Act. A clear understanding of these basics is essential for every student of commerce. Thank you for watching.